How's it, guys? Welcome back to another video. Today's video will be about my personal A plus ICT entry checklist. Right? So before going to the video, please like, comment and subscribe to my channel so you don't miss out next time when I drop another video. Let's get to the video, guys. Hey. Okay, guys, I'm going to go through the entry confirmation checklist in a chronological order, guys. So the first thing that you need to understand when trading is the most important thing you need is buyers. You cannot trade without knowing the buyers. You must always determine whether you think the market is going to go up or is going to go down. So you need to have a higher time frame point of interest. What do we mean? You have to have a higher time frame PDRA. Right? On the screen, you have this higher time frame PDRA. This can be anything from a 15 minutes to a weekly chart, because I enter on the 1 minute. So anything above the 15 minutes, I consider it a higher time frame. So you have to have a higher time frame PDRA, right? Which can either be an order block. This PDRA can be an order block, or it can be a fair value gap, right? Once you have that, you must be able to determine where was a liquidity sweep, right? Or a liquidity grab, meaning buy and sell stop are being taken, and because of that, the market is injecting liquidity into the market, right? Price is injecting liquidity into the market, because what? Liquidity moves the market. So you need to be able to understand whether we have a higher time frame PDRA in the form of an order block or a fair value gap, and whether the liquidity was being taken. If you go to the chart, look at this. This is our price. Our price. We have this high, and the price makes lower low. The price makes higher. Then if you check, we have a PD array here. This can be an order block or a fair value gap, and the market made this low. What this low tells us? This low tells us that below this low there is liquidity, because below every swing point in the market, below every swing low in the market, there is liquidity, and below and above every swing point in the market is liquidity. So the market makes a liquidity before tapping into the higher time frame PD array. So what that this means, this becomes an inducement. This induces traders to enter long trades to target this higher time frame PD array. But you understand that you cannot long before liquidity was taken. So the market generates liquidity, it comes down and take out this liquidity here. This is a liquidity sweep. The liquidity was taken, and the market tapped into a higher time frame PD array. You see this happening, you understand that there's no reason for the market to keep on going down. What do you look for? You look for a displacement above this point, above this swing high here. You look for a displacement above this swing high here. This displacement, when this displacement occurs, you can either categorize it as a market structure shift or a break of structure, right? Either one is fine, because a break of structure signals to us that a market structure shift is occurring, or a change in the state of delivery is occurring. So market was delivering lower lows and higher lows. Now the market has broken a high. Now it's going to deliver higher highs and higher lows, right? So what this tells us, when you look for the A plus ICT entry confirmation list, is you look for mostly four things. I look for mostly four things, but there can be six. So you look for a fair value gap, you look for an order block, you look for a breaker block, you look for discount and premium, you look for OTE. Those are the things that you look. So when after this displacement to the upside happens and the break of structure occurs, now we know that this higher time frame PD array from the upside, it's now our draw on liquidity. This was our draw on liquidity, and this has been reached. So the market can go anymore, so it can go and target this higher time frame PD array, right? So we have a displacement from this displacement low to this displacement high here. You look for a opportunity to go long in the market. So you look for this. You look for what? You can either look for a fair value gap here. We have, which is the first thing. A fair value gap is the first thing. Then the second thing that you can look for is a breaker block. A breaker block is the second thing. Then the third thing that you can look for is an order block. Let's say you have an order block here. We have an order block. So if you check here, we have three confirmations so far. We have a fair value gap, we have a breaker block, we have an order block. So one of the most important things that I look for before I enter the market is whether the market is in a premium or a discount, because I like to see the market. I like for the market to be in a discount when I buy and to be in a premium when I sell. So you're gonna check out your fib. Fib is a Fibonacci. You plot from the displacement high to the displacement from the displacement high to the displacement low. So you look for your 50%. This is the 50%. So that means the market is in all these confirmations are in a discounted market. That means we can buy from any of these markets. So the third thing that the first thing, no, the fifth thing that you're gonna look for is an OTE. It's an OTE. You also use the fib from the low to the high. You look for your OTE, then you realize the market is perfectly into your OTE zone. So if you check, you have a breaker block which is valid. You can get an entry at the breaker block. You have a favor gap. You can enter entry gap. You have an order block. You can enter at the order block. Then you have an OTE. You can enter at the OTE level. OTE level is anything between the 0.618 and 0.79. The 0.705 is the 50% of the OTE, which if you look at this thing also, you realize there's a line for the in the breaker. This is a 50% of the breaker, and this is a 50% of the fair value gap. So either when you want to do further refinement of your entry, you can use a 50%. You can use the 50% of the breaker block. You can take your first entry here, then you take your second entry at the order, and your third entry at the fair value gap and the OTE, because the fair value gap and the OTE align perfectly, right? So the last thing that you need to take off is your sell stop and your exit profit, right? Your take profit and your sell stop. Where would you put your sell stop? If you are going long here, let's say you're going long at the order block, because order blocks are proven to be reliable. If you're going long at the order block here, it's only fair that your stop loss, you place your stop loss below this swing low. Why are we placing our stop loss below this swing? Because this swing is a protected, I mean, market cannot come down to this swing. The higher time frame PDR has been taken, and the market has no reason to go. Where will be your take profit? Your take profit will be here at the higher time frame PDR. Here, that's where you're gonna look for another trade. You're gonna look for another PDRs or another break of structure or another liquidity sweep to enter trades, whether short or long. So you put your your take profit here, you take partials here. This will be your partials. And when you take your partials here, you make sure that you put your stop loss, you move the stop loss into break even, so that your trade is protected. So you took partials here, and your stop loss is at break even or just above the breaker block. Then you know that even if the market comes down, it will stop you in profit, and you already took partials out of the market, right? So guys, now that we understand the entry point that the entry confirmation that I look for, let's look at them in. Let's look for them in one by one. Okay, guys. Now we're going to go over the entry checklist one by one. First of all, we have a fair value gap. We have a fair value. A fair value gap. Because this thing can be used as entry point on their own. So a fair value gap, we know how to enter at the fair value gap. Wait for the market to create low, to create a higher low, then create a lower low, breaking this low, meaning taking the sell side out of sell side liquidity, then displacing above this high, then coming into the fair value gap, and you take your position here and you target the higher time frame PDRA. OTE is the same thing. You wait for the market to create a low, create a high, create a lower low, breaking this low. That means taking the sell side liquidity out of the market, then displacing above this high into the OTE level and taking your hiding your stop loss below this low and targeting a higher time frame PDR. The breaker, the same thing again. High, low, higher low, 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 breaking this one, this low to create what? To not to create, to grab liquidity, because when the market was creating this low, it was ingesting or inducing liquidity. It was using people to come and run out and run those sales here for placing up and coming into the breaker block and going up. The order block, we also know it. The box setup is something I'm to teach. I haven't taught this in the market, but what the box setup is, the nice thing about the box setup is that it doesn't even require the market to break this high. The market can here and make high or make this one. As market makes this one comes and it doesn't close below this low here, then you have your box setup. Buy from here. Discount and premium, I've said numerous times on this channel that this is the most important thing that you can look for when we are looking for an entry checklist. You cannot buy the market in a premium and you cannot sell the market in a discount. So you need to buy in a discount and sell in a premium. So before you either sell or buy, you must first check whether the market is in a premium or a discount. If it's in a discount, we buy. If it's in a premium, we sell. Right? Okay, guys. Now that we understand the theory part of the ICT entry checklist, let's go to the market and look at a few examples. Okay, guys. For our example, we're going to use the US 30 on a daily time frame. Right? So what we have the market making this low, made this high, made this low, made this high, made this high, made this low, made this high, and came down below this low. So what are we looking for? Let's replay price and see. The market made this high, then it made this low, breaking this structure here. The market broke this structure. And what did I say in the last time in my previous video? If you have not seen that, go and check it out. I said the market usually breaks structure wherever the market breaks structure first. That's where the market is going. So because we broke this low first, this is a break of structure, and this one is a liquidity grab. That means the market is not bullish, it's bearish. The market is not it's not bullish, it's bearish because we broke structure to the downside first. So we break structure and grab liquidity. Let's replay price. So from this thing, if you understand here, we have this break of structure and another we have another break. If you want, you can consider this a market structure shift. No longer a break of structure, but a market structure shift. Now we have we have a break of structure and a market structure shift. So now what do we look for? You go here, you look for a fair value gap. We have a fair value gap here. A fair value gap. Do we have an order block? We have an order block here. The open of an order block here. Do we have a breaker block? We have a breaker block. And now what do we look for? We look for whether the market is in a discount or in a premium. Then we look for our 50% here. So the market is in a premium. The fair value gap it's not in a premium, and the it's not in a premium, so we cannot sell. So we're looking to sell in the premium market. Okay, so let's look at price. Okay guys, we have replaced price here. So if you check, the market came into the breakup block. Where would you have taken your entry short? Here's your short at the 50% of the order block, or the breakup block, not the order block. You take 50% at the 50% of the breakup block, then you hide your stop loss just above this high. Then what do you target? You either target this low 1 to 1, or you target this low. Let's target this low because it's a, or you can take even this low, you can target this low, but make sure that you take your partials below this low. Yeah, take your partials below this low. So let's look at for our OTE. Our OTE is going to be something like, market tapped into our OTE. Let's move further. If the market came perfectly into the 50% of the OTE, but the market failed to close above the OTE level, right? So this is a very good entry. You take your entry there, you had your stop loss there, then that's where the market is right now. Let's replace price and see what the market did. I did not see this. This is something that you can use if you want to take, if you want to pyramid your entries. This is another entry at the fair value gap. At this fair value gap, you can pyramid your entry and target this low also again. Why? Because we have a change in market structure here. When this low was broken, the market is a confirmation that the market is going down. So you can take another entry here and target this low. I think our trade would have been complete here. Yeah, because whenever you take partials, you move your stop loss just below your entry point. So your entry point will be somewhere here. So this market will have stopped you out. Okay. Okay, guys. If you have made it this far into the video, it means you are enjoying the videos. Please consider subscribing and liking my channel so that I can continue making more videos like this. And also comment with your suggestion below on what